Ladies and gentlemen, we are extremely pleased and honored today to have with us a distinguished American and someone I'm privileged to call my friend. I will introduce him to you in a moment, but first I want to thank Shell Oil Company for recommitting to the Shell Distinguished Lecture Series this year. The Baker Institute is proud to have maintained this legacy relationship with Shell since 1995. In the past, this series has hosted distinguished guests including President Bill Clinton, UN Secretary General Kofi Annan, Russian President Vladimir Putin, Nobel Peace Prize winner Nelson Mandela, and King Abdullah II of Jordan. When we presented the opportunity to use our distinguished speaker's appearance today as the first in the 2010 lecture series, Shell accepted, and we are very grateful for that. We're also fortunate to have Dr. John Diamond here to lead us in a discussion with today's speaker. John is a former analyst for the Congress's Joint Committee on Taxation, a professor of economics here at Rice, and I'm proud to say a Baker Institute Fellow in Public Finance. There's an old Chinese saying that goes, "May you live in interesting times." Well, today's speaker has experienced very interesting times indeed. I like to tell people that I helped convince our speaker to accept the job of Secretary of the Treasury. At first, he said no, but he later accepted President George W. Bush's offer in May of 2006. And I want to tell you something, ladies and gentlemen, it's a good thing for our country and a good thing for the global economy that he did so. Named to office by the President, his tenure as Secretary of the Treasury was surely the most eventful since the onset of the Great Depression. During 2007, there were signs of emerging difficulties in the subprime mortgage market. By the collapse of Bear Stearns in the spring of 2008, it was pretty clear that a financial crisis was brewing. In September of that year, not to put too fine a point on it, all hell broke loose. Lehman Brothers went bankrupt. The Bush administration put Fannie Mae and Freddie Mac into conservatorship, took a majority share of AIG, and introduced wide-ranging legislation that permitted the Treasury Department to provide assistance to troubled firms. The title of our speaker's book, On the Brink, is no exaggeration. In the fall of 2008, large financial institutions here and abroad teetered on the edge of oblivion with potentially disastrous consequences for global markets and indeed for the world economy. And our speaker was right there. He was right there at ground zero as the United States and other governments struggled to avert a systemic meltdown. The worst of the financial crisis may now be behind us, but its causes are the subject of continuing dispute. And some of the measures undertaken by our speaker, and I should add by Timothy Geithner, his successor in the Obama administration, remain controversial. As a Secretary of the Treasury and Secretary of State, I happen to know how easy it is to apply 20/20 hindsight to events that at the time were anything but clear. Second guessing is without doubt, as I'm sure our speaker would agree, Washington, D.C.'s favorite political sport. One thing, however, is certain. When faced with a crisis, our speaker accepted the responsibility of office, and he resolutely took action. He is, by any standard, an extraordinary individual. After youthful stints in the Department of Defense and the White House, he joined Goldman Sachs in 1974 to begin a career that would culminate with his appointment as Goldman's chairman and CEO. Along the way, he found the time to become a champion of environmental protection, serving as chairman of the Nature Conservancy. And so, ladies and gentlemen, it is my pleasure and honor to introduce to you the 74th Secretary of the Treasury, the Honorable Henry M. Paulson. Hank?
I would like to welcome everyone here tonight. After reading On the Brink, I can confidently say that we are in for a very interesting discussion. It's a book that grips you like a novel, a drama, and you have a hard time putting it down at night. I highly recommend it. Secretary Paulson, I would just like to say this is a tremendous honor to have this opportunity. And I'll give you a second to respond to Secretary Baker before I ask my initial question.
Well, John, thank you very much, and thank you all. And I would just thank Jim Baker for his kind remarks. Like so many other Americans, he's one of my real heroes. And, you know, he's right. When I was struggling with whether or not to come down and accept George Bush's offer, and it turned him down a couple times, I had some conversations with Jim Baker, which made a big difference. And then when I decided to come, I remember saying to Jim, I don't want to take this job on unless I can be effective, and I need to decide what to ask the president for. And he said, well, if you stop and think about it, Hank, if you just need to insist on being the primary economic advisor and spokesman for all domestic and international economic issues. And he says that about covers it. And he said, now, I've got to say I did that, and George Bush agreed, but I'd had a career in investment banking where I'd worked for a good number of principals. And I realized it's one thing to have that in agreement, and it's another thing to have it come true. And so I realized that the onus was going to be on me to develop a relationship of trust, and because otherwise the agreement wouldn't have meant a lot. But it was a great way to start.
Excellent. Well, my first question is, one of the first problems you began to tackle at Treasury was reforming Fannie Mae and Freddie Mac. It took 2 years and a crisis to get meaningful reform. Why did it take so long, and do you think that reform will provide a stable, long-term foundation for these government institutions?
John, first of all, there's a number of themes in the book, but I think one of the lessons is that it is extraordinarily difficult to get Congress to act and do anything that's big and controversial and difficult unless there's a crisis. And with Fannie Mae and Freddie Mac, these institutions were very embedded in Washington. They had thrown a lot of money around on both sides of the aisle, so there's great support from the standpoint of Congress. And it didn't take a lot of vision to see there were accidents waiting to happen because they were poorly structured. They had the implicit support of the United States government without the explicit support. And they had very flimsy capital rules that were set by Congress, and they were a real problem. And I began working on reform, and I could see we were going to get nowhere because people on one side practically wanted to drive them into the Potomac because they were so flawed structurally. And people on the other side were encouraging them to continue to make more subprime loans and do dangerous things. And so one of the first big tests I had with the president was after the midterm elections in 2006, when the Democrats had control of both the House and the Senate. I had a very eventful meeting where I said I wanted to get in and compromise and go for half a loaf, because half a loaf was better than nothing. And otherwise, the president was going to leave office without reform. And so that opened the door to begin working with Barney Frank, and then it took the crisis to get the powers we need. Now, I need to correct you. We did not reform Fannie and Freddie. That has not been done. They were getting ready to melt down, and I went to Congress and persuaded Congress to give us unlimited authority, financial authority. It would have been politically incorrect to say unlimited, so I said unspecified, but it was unlimited authority to step in. And so we stepped in and put them into conservatorship, put the government's credit behind them. And I think it's obvious to everyone that they were a flawed structure and that they can't continue in their present form. But right now, there is no answer. I have some recommendations I made in the book, and I think they need to be dramatically restructured, scaled way back at a minimum. But it's impossible to do that now, given the fact that the housing market is still in some distress. But it's a major job that needs to be done.
Very well. That brings up other institutions that may need to be reformed. It's ironic that part of the intent of the Glass-Steagall Act of 1933 was to separate commercial and investment banking activities. But during the darkest hours of the crisis, a major goal was finding commercial banks that would buy Goldman Sachs and Morgan Stanley. Ultimately, we just transformed them into commercial banks. Should we reconstruct a wall between commercial and investment banking, for example, by adopting the Volcker Rule, which would prohibit proprietary trading, or should we go some other route to accomplish that?
I think another route is the right way to go. We have a greatly flawed, outdated, outmoded regulatory system without the authorities we need, and it needs to be reformed. And we put forward the model for doing that in March of 2008. Now, there's no doubt that the concentration in these large financial institutions, and the 10 top institutions now have 60% of the financial assets, as opposed to 10% that they had in 1990. And they're difficult to manage, and they pose a dangerous risk. But if we'd had a ban on proprietary trading, that wouldn't have stopped they wouldn't have stopped Lehman Brothers from failing, wouldn't have stopped Fannie or Freddie, wouldn't have stopped Wachovia, wouldn't have stopped WAMU. What I think we need is a systemic risk regulator and tough regulation, so we have a regulator that can get all the information they need and can step in any type of institution and deal with any type of business activity that threatens our financial system. It may be trading, and I got to tell you, the biggest trading risks aren't proprietary trading risks. When they're huge trading risks, that's one risk. But so that number one, and then number two, I think we need resolution authorities so that none of these institutions are too big to fail. That if they run into a problem and they fail, we know they're going to be liquidated. We're not going to use taxpayer money to prop them up in their present form. They are going to be liquidated over a period of time, and I think that's what we need.
Very well. In reading your book, I was struck by the fact that you devoted 38%, or 173 pages, to 1 month, September 2008. Talk a bit about what life was like for you and your staff and the others you worked with during that period.
Well, it was, let me say, it wasn't just September. We went from, I think, mid-August, when we were racing to deal with Fannie or Freddie and stabilize them before Lehman announced its earnings, right through mid-November, when we were rescuing Citigroup, where it was just, it was nonstop. But in September, I would talk about that week. There was the week when Lehman failed, when AIG was rescued, when Merrill would have failed if B of A hadn't bought it, when we had $3.8 trillion of money market funds that came this close to imploding, when major blue chip industrial companies couldn't issue really paper with any certainty. They were just able to roll it over commercial paper for a day or two. And so when these big blue chip companies were having trouble funding themselves, I knew we were on the brink then. And if the system had collapsed, we would have had a situation where many industrial companies of all sizes couldn't fund themselves, couldn't pay their suppliers, couldn't pay their employees, and this would have rippled through the economy. And I think very easily you would have had unemployment of 25%, all kinds of lost value. And so this was a period where we had to move very quickly, had to take actions that were unprecedented, and then we had to go to Congress. And for some time we knew we needed to go to Congress, but nothing would be worse than going to Congress and saying we've got an emergency and not being able to get the powers. And we had a tough case to make to Congress because we saw that the markets were frozen. We knew the economy was going to turn down no matter what Congress had done, given the shock that had already taken place. But members of Congress didn't see it yet. And so we needed to get them to act. So it was a period of time where we were moving very quickly, and fortunately we held the system together.
Interesting. I actually recently read a paper titled Paulsons Gift, which is written by two very notable economists that speaks very well of the actions that you took as Treasury Secretary. Although the Congressional Oversight Panel stated that the failure to rescue Lehman Brothers was not consistent with the involvement of Treasury and the Federal Reserve Board in the rescue of Bear Stearns. Why were you able to save Bear Stearns and AIG, but not Lehman?
Yeah, I tell you, there are very few people that understand this. And it's an amazing thing. I've explained this multiple times, and I've said to people, "Now, do you still understand it?" And they don't. So I'm gonna try to do this. And I recognize it. I also tell the story that when I was in the UK, when they were fumbling around with Northern Rock, and they were explaining to me they didn't have the authorities, and I looked at my chief of staff and said, "Yeah, likely story. That Her Majesty's government can't find the powers here." So and yet this is a situation where Ben Bernanke, Tim Geithner, and I have all said we didn't have the authority. And when people are skeptical, no one tells us what that authority was we have. They just all believe somewhere we must have had some authority. And they say, well, you saved Bear Stearns, you saved AIG, you let Lehman go, therefore we rest our case. Well, they were very different situations. Bear Stearns was an investment bank. It was disintegrating very quickly, and a chance of liquidity was going. They told us on a Thursday night they were going to file for bankruptcy on a Friday morning. We did not have resolution authorities. There's no authority, emergency authority, to step in and avert the bankruptcy process for a non-bank. We were very fortunate in that we had an interested buyer in J.P. Morgan, with a CEO who was confident, who had the confidence of his board, could move fast, because we knew that if we didn't announce a deal by the end of the weekend on Sunday, this bank was going to just disintegrate before our very eyes. A run had started. And so there was a capital and a liquidity problem, but J.P. Morgan agreed to step in, buy, and guarantee the trading book, which is very important during the pendency of the shareholder vote. Otherwise, the company would have ceased to exist. Now, the Fed helped with the funding and made a loan against mortgages. And the Fed had emergency power to do that under certain circumstances, and those circumstances were met. AIG was another situation where you had insurance companies with independent credit ratings, and then over them this holding company, which was like a hedge fund, which was a mess. And there was a big liquidity problem there. And at the time, the market felt that there wasn't a capital problem, there was a liquidity problem, and the Fed was able to legally loan against the insurance companies because they had independent credit ratings and to secure the loan, and the market accepted that. Now later, when the situation got worse at AIG and the market learned more about it, and the rating agencies a couple of months later said there's a big capital hole, AIG would have imploded, but now we had the TARP and we could put capital in. So Lehman, on the other hand, there was a capital problem and a liquidity problem. We were in the middle of a bank run, and we worked hard, but the one buyer was seemed like the best buyer, B of A, decided to buy Merrill. Now, if they'd bought Lehman and hadn't bought Merrill, then Merrill would have gone down. But they bought Merrill, and we had one bank that was interested, Barclays, and at the very last minute, and the British regulators wouldn't approve it, and so there was. For the Fed to loan, it would have been a lost game. They would have been lending into a bank run because there was no way to guarantee that trading book. But see, I went through a long explanation, and I probably shouldn't have done it because how many of you understand what I said? Yeah, good. Well, if we have someone in the front row that does, and I won't ask her to explain it.
Many politicians and other commentators have implied that TARP, the Troubled Asset and Relief Program, was a bad deal for taxpayers. How would you respond to someone that asked you why you did not negotiate a better deal for taxpayers? And I guess my part of that question would be, why did the counterparties to AIG all get 100 cents on the dollar?
Well, remember, you're confusing two things, John. Okay. So let's start with the TARP, okay? Do it. Because the TARP had nothing to do with counterparties for AIG.
The government backed up all the AIGs.
That's the Fed. Okay, so let's start with TARP, and it'd be a good idea. So the TARP is one of the best deals the U.S. taxpayers will ever have. Okay, because the first thing is the TARP averted a huge disaster. Okay, it worked. Secondly, the money that we put into the banks is coming back with a big profit, okay? And I believe the other money that came out of the TARP, with the exception of the money that the Obama administration has spent, which is a spending program, not an investment program for mortgage foreclosures, which, that won't come back. But I think the money for the TARP, by and large, is going to come back with a profit. Now, in terms of the banks, I think it's important for people to understand this. It's really important that the way we designed the bank plan, and I advocated this quite strongly. We had a system that was greatly undercapitalized in the banking system, and so we set attractive terms to encourage many banks to participate. But the day we announced it, some critics immediately started saying, you should make the banks lend. And they didn't say how much you should make them lend or how it was the government would make them lend. And a few days after that, Congress started saying you got to control their compensation and control their lending. Now, I was pretty clear why we'd done it was to make it attractive to many banks. I thought we'd get 2,000 to 3,000 banks, community banks, to participate. I thought they'd keep the money for 3 to 5 years, and this would bolster lending in the country. But when Congress started talking about putting strings on this money and then retroactively changed the rules, we had many banks that had applied and been approved, didn't take capital, others rushed to pay it back. Now, so instead of having 3,000 banks, except we had 700, a little bit under 700. Now, the good news is it worked, the system didn't collapse, the money's coming back with a profit. The bad news is, I think those people like the Congressional Oversight Panel that said it didn't work because guess what? We'd like to see more lending, and guess what? We just discovered that many community banks have commercial mortgage losses. It was those people that stigmatized the program and kept more banks from taking the capital that made it not as effective as it might have been. And in my view, it would have been much more effective than any stimulus program or whatever. Now, in terms of the question you asked about the Fed and AIG. I was very supportive of the Fed's action to rescue AIG. We didn't have authority at Treasury. The Fed made that decision. The Fed made, and then the Fed managed that loan, and the Fed made the decision to pay counterparties. So I read about that in the paper when it was disclosed they made the decision. But let me point out to you, first of all, not only do I have great confidence in the judgment of the people making those decisions, but that the Fed did not have the authority, none of us had the authority, to wind down a failing institution outside of the bankruptcy process. And I'll just tell you that if AIG, which had guaranteed tens of billions of dollars of retirement accounts for American workers, their GIC wraps, and had tens of millions of insurance companies and $1 trillion of liabilities, if that company had gone down, it would have been economic Armageddon. So again, I think the case that we did not make, and I was harder on us until I found that even a president who is a great communicator hasn't been able to make the case, that the case between Wall Street, the relationship between Wall Street and Main Street, and that none of these rescues or bailouts were done for the banks. They were done to prevent disaster from occurring for the American people.
Very well. I'd like to open the floor and allow audience questions now. A few rules. Please keep your questions short. Please make them questions and not statements. And so just walk up to the microphone. Please state your name.
My name is Tim Mattingly. I saw you on C-SPAN a few weeks ago when you were talking about your book. And one of the questions asked was, you worked for a while under George Bush, and then as you talked about Barack Obama. What's the difference between the two from their business acumen? Well,
I've worked for one, not for the other, so I'll just talk a little bit about it. As I've gone around and talked about my book, many people who have listened to or have a caricature of George Bush, find this sometimes difficult when I state what the facts that I saw. Because in George Bush, I saw a man who understood markets and who was prepared to do things that were politically unpopular. And so time after time, I came to him with bad news, told him we needed to take dramatic, difficult steps. He was no fan of Fannie Mae and Freddie Mac, and no fan of Wall Street. He didn't want to be president to do the bailouts. I certainly didn't come to Washington to do bailouts. These were very objectionable things. The only thing that was worse was what was going to happen if we didn't do it. And so the man I saw was one who bucked me up, supported me. I never had to spend a lot of time trying to persuade him. He was someone that was very supportive. I never have had a chance to work for Barack Obama. But let me talk about Barack Obama. One of the themes of the book is a collision of markets and politics. And the credit crisis couldn't have come at a worse time because it was weeks before a national election. And if either candidate, if either Barack Obama or John McCain had opposed the TARP, we wouldn't have got it. Or when we switched to put capital in the banks, if they'd either one had attacked that, they would have stigmatized it, and even the first 9 banks wouldn't have taken the capital. And so the Barack Obama I saw before the election was someone who was quite knowledgeable, articulate, very encouraging, reaching out to me, communicating frequently when I asked him to help with certain people, helpful. I also explained that I had my last conversation with Barack Obama the day, before once he was elected. I haven't talked with him since the election, and it was cut off immediately. That I had much more difficult conversations with John McCain as we went through, but I was always very grateful that no matter how difficult the conversations were, and my heart was often in my throat, John never, ever opposed anything we did, and he supported the TARP, and if he hadn't, we would have been left defenseless. So now it's determined what kind of President Barack Obama is relative to George Bush. I'll let history decide that, and I think it's just early days still.
Questions? Please come up to the microphone.
Hi. In the wake of the financial crisis, derivatives have become a bit of an ugly word, and I'm wondering if you were asked what could be, what regulations we could introduce that would be effective at allowing derivatives to still play the important role they do in the economy, allowing people to manage their risk, both corporations and individuals, but still, prevent another Bear Stearns from happening. What form would that take?
Well, this is something, and I'm quite optimistic. My views are shared by a number of people, and that there's a good chance that we will see legislation along these lines. And as you said, derivatives are valuable tools, but during the crisis, sometimes rather than mitigating risks, they accentuated them, transmitted them. So what I think we clearly need is standardized derivatives, which is the vast majority, to be traded on exchanges, number one. Number two, all those over the non-standardized derivatives to be traded, go through central clearinghouses. And then on top of that, since it's very hard to regulate against complexity, and since complexity was our enemy here, was the enemy of transparency, I would have big capital charges imposed on those non-standardized derivatives. And I think if you do those two things, it'll go a long way to solving the problem. Now, I think one of the things that is troubling to me is that we're starting to see some protectionism in the form of regulation. Regulation had been a bad word before the crisis, now it's a good word. And so I'm concerned about rules that say, well, if they're, if it's in Europe, you can only trade them on a European exchange. And so we're seeing a number of, protectionist inclinations, but I think there's a very good chance that this will be sorted out and we'll get the kinds of change we need. But don't blame derivatives entirely. You solve the derivative problem, we've still got a good number of other regulatory problems that have to be solved.
Susie Hoyer, and you might be interested in knowing when you were having the terrible time with Merrill Lynch, and that weekend we had Hurricane Ike here, so we were also having a terrible time. Question, what advice would you give to Tim Geithner regarding all the mortgages that are still being held at the Fed, and what would be your suggestions on what to do with that problem?
Well, it's Ben who's going to deal with the mortgages that are held by the Fed, but let me just talk about housing overall and say that I have the highest regard for Ben and for Tim. And I still talk with them, and the advice I give them is private. And when I talked with people when I was there, I wanted them to keep the advice they gave to me private. I never liked it when I had my predecessors giving me public advice. Now, but what I will say some of the things I've said. Yeah. But I'll say some of the things you sure didn't. It was one of the things I've said all the way along is this. To begin with, I think one of the big problems we had, and one of the reasons for the crisis, was the combined weight of a good number of housing policies in the U.S. Home ownership is a great thing. We all want people to own something, but the combined weight, when you look at the subsidies through Fannie Mae, Freddie Mac, the FHA, state programs, the mortgage interest rate deduction, they push the prices of home ownership way past the point where it made sense. And so we need to rethink all of this, and we need to really recalibrate that, number one. Now when you get to the programs we put in place, that have been put in place, I think getting in to these programs was critical. I was there and I was a first responder. I think the exit strategy is extraordinarily important. How do you get the government out? And I think there's certain programs that are being exited, but the program where the government is there with both feet in a way which is not sustainable and not good, but it needs to be there now, is housing. We talked earlier about Fannie and Freddie. I mean, that's really the mortgage market, and it's a government guarantee. So how those entities are restructured and how we get out of that. And then, of course, as you've pointed out, one of the things that made sense that both Treasury and the Fed did, the Fed to a much bigger extent, was to buy in mortgages. The theory being that you had a government guarantee behind them anyway, and so if the government is able to fund itself at 2% or less, to buy in Fannie or Freddie paper, GSE paper at 5% is going to make sense and keep mortgage funding low. And Ben has said he's going to unwind that, and I think he's as good as anyone I know in figuring that out, and he's going to have to figure that out. And I certainly can't sit here and say this is how, the pace at which you should sell those securities, but it's got to be done. And when it's done, the government will have made money. And so I think when you look at the sum total of all of the things that have been done, I think people are going to be surprised, because I think the government will have either made money or lost very little money on these programs, but they need to be unwound and we need to exit them.
Mr. Secretary, did Kenneth Lewis, then President and CEO of Bank America, during that weekend that you described, the end of September, did he ask your permission or advice to purchase Merrill Lynch? And further, going forward a bit, after that weekend, before December 5, 2008, did he ask, again, your permission or advice as to proceed with purchasing Merrill Lynch?
With Ken Lewis, he, as I've recounted in my book, I was working with him very hard to try to persuade him to buy Lehman Brothers. He did not ask my permission or advice before acquiring Merrill Lynch. I frankly think that if he hadn't acquired Merrill Lynch, there would have been a disaster. And then, as I've again recounted, and as I've recounted to different congressional committees and in my book, I pressed him hard when he came into us and told us that he had doubts about proceeding.
Was that not after December 5?
Yeah, that was, as I said, that was I don't remember the exact date, but it was mid-December.
Thank you, sir.
Hi, Chris Keller. I'm a student at Rice University. When I first applied to Rice University, actually when I first visited in 2007, my family could afford for me to come here. And then when I finally was accepted, I'm now here on scholarship. And it was kind of a scary time for us. And I was just wondering, what advice do you have for me as someone who in 4 years will be out there as an investor, as a homeowner? What advice can you give me in terms of where to put my money?
That's one thing. I had Warren Buffett, when I did something early on, ask me also how to advise people to invest. And I said, that's one thing I don't do. But I again will tell you that markets are stable. I believe the worst of the crisis is clearly behind us. Markets are starting to recover. I have very significant concerns longer term in terms of the embedded structural fiscal deficit, particularly with our entitlements. And that's going to need to be fixed. I have concerns about needing regulatory reform. I think in terms of advising people where to put their money, it always comes down to their individual financial situations, their goals, and their time horizon. And I continue to believe today that for people that have a long-term horizon, there's nothing quite as good as picking outstanding companies that are going to be around for a long time and do well. But that's again for young people that have got a long time horizon.
Well, that dovetails into my question. All the talk shows are talking about the solvent seniors having funded this bailout. Did Solvent, as a formerly solvent senior, I won't say whether I'm formerly solvent or formerly senior, is this a bailout that came on the backs of people with money in the banks?
Well, in terms of solvent seniors funding the bailout, the taxpayer funded the bailout, if it's a bailout, and it will be, and the money, as I've said, is going to come back with a profit when you look at it also, and a disaster was averted. So I am totally convinced that working with imperfect tools and authorities, when I look back, I think we made the right decisions by and large, and that they averted a disaster. Now, I'm going to turn your question around, because I think one of the things that concerns me right now in a country is that if you look at families, senior members of families want to save to pay for their children's education, to help their kids lead better lives than they have. But as a society, the solvent seniors are eating their young, because what we're doing when with our entitlement programs is we are putting in place programs and have in place programs that are benefiting the seniors, and those that are going to pay the price are the next generation and the generation after that, because this is about generational fairness, and our children and our grandchildren aren't going to be able to live the way we live unless some solvent seniors are prepared to sacrifice for the good of the country.
Mr. Secretary, my name is Radu Filip. I am a Rice alum and also a first-generation American. My question to you is coming along the lines that as a country, our debt continued to increase steadily, not only during the crisis, but for the past 2 decades or 3 decades at least. So my question to you is, in this century to come, how do you think that we as a country can continue to be a world superpower when we are on the brink of becoming an AIG on the world stage, a country that is being propped up by foreign government and corporations for as long as they will have this interest? Thank you.
Yeah, well, I can see what your view is, and let me say this, because I think you're pointing to a major problem. First of all, don't confuse two things. In the short term, the deficit numbers look artificially large because some of the programs that have been done were investments, and those will unwind and the money will come back. But the big problem is the one you've pointed to, which is all of the analysis I did when I was Treasury Secretary and everything I've done since has, just convinced me that by far the biggest threat we have and the biggest economic problem we have is this looming, fiscal problem and this big embedded deficit with Medicare, Medicaid, Social Security. Now, I think we can solve it, and I think that every other major economy has got more significant problems, economic problems, than we do. China, we could just tick off the problems, but they've got more significant problems. India does, they all do, but ours, we're going to need to solve. And you're certainly right about one thing. You look through history and you're not going to find any superpower, any power that was able to maintain its position with a big fiscal problem. In other words, if you're not a strong country economically, you're not going to be your national security will slip. You will just not be. We will not have the status. Now, I think we can. We've sure got the capability to solve it. We're the biggest, richest country in the world, but we have to have the political will to do it, and therein lies the problem.
My name is Joan Newhouse-Shawn, and one of the issues that really troubles me is the fact that with derivatives and syndicated loans, the person that originates the debt instrument often makes a fee and then passes the instrument on for the risk to someone else. They don't often retain much of that risk themselves. So their motivation, therefore, is to generate as many debt instruments as possible, to generate as many fees as possible, without any sense of or having to carry the weight of the risk. And yet those derivatives are passed on, or the loan syndications, to other banks and to the investor. And how do we then make sure that the loan, when it was originally made, meets the right risk profile? You touched on this with the mortgages, but that is a sort of a fundamental, I think, landmine that we're facing.
Yeah, you've pointed to a significant problem, and it's one I talk about in the afterword of my book, that and particularly in the securitization area, when you have, when underwritings are done, I think people would feel better if the originator was required to keep some of that risk on their balance sheet. It is, and it is easier to make that recommendation than to figure out how to make it work. I made that recommendation, okay, and I think I've got some ideas on how to make it work, but it is, and a matter of fact, those who want to argue the other side can say some of the institutions that failed were those that ate all their own cooking and kept it. And Merrill Lynch had a tremendous problem keeping big hunks of AAA rated subprime CDOs and securitizations on their balance sheets. So I think there are a number of things that need to be done, and there's a lot of work that needs to be done with the rating agencies. There's a lot of work we need in terms of transparencies. The whole mortgage origination process was not properly regulated, and at least half of those mortgages were originated at the state level without federal regulation. So it's a complicated, difficult process, but I think it is. I do agree with your presumption that originators should need to keep some of the risk, but I also think a big part of the answer is going to have to be capital and liquidity requirements, and the rating agency is doing a better job.
Mr. Secretary, my name is Jim McCon. If you've had a chance to become familiar with it, do you have any opinions to share on Senator Dodds' bill? Or otherwise put, if you had his job, what would be the main agenda? Maybe you've just spoken to some of those.
Well, yeah, one of the things I'm proudest of is before the crisis hit full force, we came out with a regulatory blueprint in March of 2008. And many of the ideas, were things we've been recommending. I was making speeches in June and July calling for the kinds of resolution authorities that are in Senator Dodds' bills. The systemic risk regulator, which I talked about earlier, is something we've recommended. So I think there's some very good things in that. I've said I think the most important thing we have is a systemic risk regulator and the resolution authority, and there's some, I've given you my views on derivatives. That's not a perfect bill, and I'm hopeful that with some of the work that Judd Gregg and some of the Republican senators are doing, that the bill will become stronger. But I'm optimistic that we're going to get some fundamental reform, and I'm staying very close to that, and I'm supportive of a lot of what's being put forward. Not all of it, but a lot of it.
I think we have time for one more question.
Will the next round of financial regulation be on the order of the 1933 and 1934 Securities Acts, or which were widespread or very sweeping documents, or do you foresee something a lot less than that?
Well, I think I wouldn't. I think if we get the kinds of things that people are talking about, it will be very important. I'm not sure I would say it's as sweeping as what we saw after the Great Depression. I very much see a need, though, to have the kind of overhaul where we have a system, a regulatory system that will work for financial markets however they develop. Because what we've had, for many years now is a failed regulatory system. A system where rather than having regulators, having a regulator, focus on all of the major financial institutions, we have financial institutions picking their regulator and trading one regulator off against the other. We had a situation where AIG had a largely unregulated holding company. And when you have a financial institution being able to build a business model around cracks and gaps in the regulatory system, that's not right. So I'm hoping that we're going to come out with something that will be more than enough to adapt to the financial markets however they change in the future.
We still actually have a couple of minutes left. We'll take one more question.
Mr. Secretary, my name is Bob Biekovich, and I'd be curious, I think from what I've read in the next few weeks, that your successor, Secretary Geithner, is going to be coming under some pressure to make a statement about whether or not China is artificially suppressing its currency, and I'd be interested to know your point of view on that.
Well, I'm not going to comment about what in any kind of public forum about what Tim Geithner should do with China and the currency. So I will just make a general statement, which is this: that with China, you have a huge economy that is still developing, and although there are many countries in the world that don't have market-determined currencies. There's no country that is as big and important as China, that is so integrated into the global market for goods and services, the trading markets, that doesn't have a market-determined currency. And so when I was Treasury Secretary, we didn't pound on this a lot publicly, but we worked very hard with the Chinese, explaining why it was in their interest as they continue to reform their currency, because they're not going to get where they need to get in terms of their economic reforms and opening up their economy and moving up the value-added manufacturing chain so they're not so dependent on low-cost exports. And they're not going to get to the point where they're able to spread the wealth more broadly among their people unless they continue to reform their economy and their currency. And when I was spending time talking with the Chinese about their currency, the currency moved. So it appreciated pretty significantly during that period. And so that's sort of my general approach, and to explain to and the Chinese have consistently said that they were going to continue with reforms. And I always said to them, we agreed on what they should do in terms of opening up their economy to competition, reforming their currency. But the differences were, I thought they should do this much in this period of time, and they wanted to do this much in this period of time. And so, I would always argue, I believe in free trade, but it's going to be easier for me to fight to keep our markets open for your products if you keep opening your markets for our products. But again, we don't ever make the mistake of thinking that if China has economic problems, that's going to be good for us, because it isn't. We need them to keep growing and progressing, and they've got a long way still to go, but we have to forcefully and consistently and I think quietly make our point and explain why it's not just good for us, but it's good for them and good for the world economic system. Thank you.
Secretary Paulson, thank you for...
Thank you, ladies and gentlemen, and thank you, Hank, for being here with us. Thank you, John Diamond, for moderating the session. I would be remiss if I didn't introduce Wendy Paulson to the audience here. Wendy is traveling with Hank, and she's right here in the first row. Stand up, Wendy, and let everybody see you. And I don't want to... I probably ought not to say this, but I think you could read in Hank's last answer that the answer to your question was yes. But anyway, thank you very much for being here, Hank. It was a terrific program. Thanks so much.